Thank you everyone for joining today. Happy New Year to all. So today we are going to discuss about real estate and fixed deposit. It is a good combination or not? We will discuss throughout in this webinar. Let me begin with a simple thought. Most of us believe that being conservative with money is smartest thing to do. Save regularly, avoid unnecessary risk, protect what you have earned for a long time. This approach made a lot of sense, but today it has changed because it's inflation is quietly redefined what actually safe means. Money maybe look stable on paper, doesn't always remain stable in real life. Returns may look attractive at first glance, but when you account for taxes and inflation, FD's returns are mostly net zero like that only. So on the other side, if you look at real estate, its incomes are uneven. Maybe two people can make very similar decision. It end up with very different results over time. We can look out in detail in the webinar. At the same time, our goals have become more demanding. Like education and healthcare costs are rising faster than we expect, and money is expected to work harder and not just put it somewhere else. Okay, which brings us to the uncomfortable too. Stability alone is no longer enough to fund long-term goals. And here is the most important point I want to reflect on. Sometimes it's trying to avoid risk, but we end up creating a different kind of risk. That risk doesn't show up immediately, but it show up doesn't feel scary day to day, but is risk that quietly shows up when your goal approach. So the purpose of the session is not tell you that traditional choices are wrong. They exist for very good reasons, but at the same time, we can look at what are the other alternatives we have with the for same conservative approach, but we can look up new other alternatives. We can look for our investment goals. Generally, what investors mean by safe? First is no shocks. That is, they don't want to suddenly see their capital fall. Sometimes even the fall is temporary. It creates discomfort for us. For many people, capital stability matters more than how fast money grows. It's right to think in a way because we want to protect. We are working really hard for us to earn money. We need to protect. So that is very important thing. But and the second thing is no surprise. Like they don't want to see the market volatility. Like sometimes market are moving every day just up and down, so they don't want to see that. So like if in FD kind of thing, our returns, we know our time frame and everything. No, so that is also one of the reason we prefer traditional investments. And the final one is no regret. If both no shock and no surprise we have, of course we don't have any regret. We can have a peace of mind in our investing. Like people want to feel the decision they make today feel very sensible when they look back days later. They don't want to feel they were reckless, like don't want to explain uncomfortable outcomes to family members, or that peace of mind is really matters when come to investing. This is why many investors prefer choice that are very acceptable, familiar, and very widely used. So next thing is risk what we see. This is risk what we miss. As I said, seeing risk are we know that like the market volatility, these are, we can see the prices go up down, the movement is very visible, and the volatility, daily, the short term fluctuation, these are the risks that shows up every day on your screens or headlines news, because they are visible. So they feel more dangerous to you. But even if that impact is temporary, the emotional reaction is very strong. Now if you look at the right side, these are the risks we usually fail to miss, not because they are small, but because they are very quiet. It is not visible to us. Like inflation also is slowly erode your purchasing power. Your money doesn't fall, but it slowly buys less. And you see, next is liquidity risk. It shows up only when you need money. Until then, everything looks fine. And the next one is opportunity risk. It is mostly invisible of all. It's not about losing money. It's about not letting money grow enough when time was available. So the interesting part is we often very work very hard to avoid the risk, we can see, well, unintentionally taking on much larger risks we can't see. So risk is not just about price movement. It's about what silently erodes our wealth overcome over time. And this difference is exactly why some safe strategies feel comfortable to today, but it's precious later. And this slide is, we can see what are the things really working fixed deposit and what are some of the limitations uh, we can face, right? What first actually works is FD gives capital protection. You have the comfort of knowing your principal is safe, and it gives you very predictable income. You know the how much rate you will get. You know the timeline, and you know how much your maturity value once your tenure is over. You don't need to actively monitoring everything. You don't need to track news or prices and nothing. So you just have to put in some good bank deposit and just everything. And also it's very simple and familiar. It's very easy to understand. Okay, unlike the market kind of products, it's having different, slightly complex. You need to understand a lot of things. But in terms of FD, it is very simple product, so everyone can easily understand. It is very familiar to us. But when investors choose FD, they are not being careless, they are choosing peace of mind. But every financial instruments also has limits. FD returns are taxed every year, so it will affect your compounding over a long period. And also inflation is slowly eating your purchasing power, so that is also you have to be considered. Also, there is a reinvestment risk in case your future rates will comes down. If you put another FD, you may get a lower return rate. So that is also one thing we have to consider. And also, FDs offer very limited long-term growth. Okay, mainly, FDs are good, but if you use it for long term, then only we can maybe face some certain problems here. This slide is, I just assume a little bit calculation, like assume we invest some 1 lakh amount. I know the FD rate, if I just check some one of the banks interest rate in the period of 3 to 5 years, it's around 6.3%. So we can take that. We can assume inflation is 5% now. Then tax slab will be assume we have 30 percentage. Like if we invest 1 lakh in FD, after it's matured over 5 years, 1 lakh, around 1,35,000. So the amount of interest we have earned is 35,000. And if you look at after the post tax calculation, it will come around 1 lakh 25,000. But if you reduce it with inflation, it will may, like, in your net level again, it's a very minor loss. If you look at your capital is very well protected, but if you look at the growth side, it's very limited. Your capital is totally protected, but you cannot be able to get the required returns, or I mean the required growth in the FD. So that is the one of the problem we can see in after post inflation in FD. So next, we can look about the real estate. So real estate is always hold a very special reason because it's physical and tangible. We can see it and visit. We can feel that sense of ownership while we holding. So it's also maybe look as an inflation hedge because during very long term, by holding for more than 10 or even more than years, maybe we can see it as even it can outperform inflation also. And also over long periods, property prices tend to move up if economy growing well. That is also a solid reason. And also you can get some of the additional passive income also through rental. You may have the steady cash flow also, and also over the long term, it is also the value of your property also goes beyond numbers. So, and also most important thing is properties have carries our emotional value. It's a kind of a more emotional investment for us. It's carrying our legacy. We can pass it to our next generation. So that's always something very permanent one. So that is very important one. But when you look at what are the some of the risk we can see is your capital may be lock in investment for very long period, and also maybe return may be very different based on the cycle, economic cycle and the location where you are in some of the location, property will go up, but some area maybe you can see you don't get that much returns. And also, if you look at rental yields are relatively low. It's mostly you can get around 2 to 3% in general if you look at it long. And also, when liquidity is a big problem, you cannot easily find a buyer or seller immediately. So it will take very much time, and most importantly, outcomes are visible only over many years. In case if you are investing for a specific in a short term duration kind of investment, so it is a very risky thing to do in real estate. So it's about understanding that time and flexibility matter as much as the trust. So we can see real estate by seeing two scenarios. Okay, let's assume a father is investing in real estate for the son. In next 5 years, okay, we assume he is in some sounds or standard. Maybe after 5 years, he want the money, so he is investing in real estate. We can see the first scenario. If you look at the first scenario, he is entering in the peak cycle. Okay, so because he was purchased during a stock market, prices don't crash, but maybe it can be very stagnant or very soft, and he may not even get the growth. Maybe property may lose the value slightly. Maybe first few years this doesn't feel like a problem. Once the goal approaches, uh, when the timing suddenly matters, when sellings also take time, you have to negotiate with the buyer. Liquidity becomes the biggest problem here, because you want to maybe you purchase at one core, you may even end up selling at the same price, or you may even able to take a bit of a loss to sell the time, because you have a goal to pay your son's education fees. So that is very important. When goals are time bound, the flexibility is more important. So the issue here is the mismatch between the property cycle and the fixed goal timeline. So this kind of investment is maybe it's wrong this time. Yeah, another thing we can look at is maybe we can see the different growth outcomes. Okay, the same property, the same holding period, with a different outcome. We can say by 4% it will grow around 1.24. Maybe you can, if you add rental in, maybe you can get 1 or 2% extra. But still the outcome is modest. Maybe if you adjust for the maintenance and vacancy period, you will get the same level of return. After 6%, maybe it's look better. uh, it's a modest level of return maybe we can expect, and 8% is a very good level of return. But at the same time, you have to enter at the right cycle, because you have a goal for 5 years. That even if you enter in the right cycle, maybe you can get the both appreciation and rental income start working together. Yeah, and also, the NAF is that your rental income is not fixed. Maybe the maintenance cost also maybe rise over time. Most of the time, maybe you may not even able to find a tenant, so your property may be vacant for some time. So, and also you have to depend heavily on the location, timing, and market cycle. So, while real estate can work very well, but the outcome may be different. Maybe in a different situation, we have to understand our goal and what cycle we are in. We have to understand everything, and then we can enter in today if we want to invest in real estate. That's very important. And this slide is about what are the impact if we completely avoid the markets, or just fully rely on FD and real estate. So if you invest in FD and things, we have very limited market for sure, and it comes from stability and predictability and peace of mind. But once market exposure is very limited, something else starts to happen. Currently, your growth is very slows down. Compounding becomes very slower. It's not in negative, but it's very slow. Your outcomes, your goal and target will it take much longer. Even sometimes when goal may able to disappear, this just get pushed further into future. Like your education, retirement, your lifestyle goals, everything takes more time. When timeline stretches, your flexibility also reduces. There is less room to adjust, less room to correct, and you have fewer choices. If something unexpected happens over time, this lack of flexibility actually increases long-term risk, even though everything feels safe at beginning. So this is the important insight. Avoiding market reduces visible discomfort to brain, but it can increase invisible pressure tomorrow. This is not about taking more risk. It's about understanding that too little growth is also can be a risk, just a quieter one. So here maybe we can compare traditional strategies with the like the same conservative kind of strategies. Like in mutual funds, we can see there are debt product, hybrid product. They are also conservative, and there is be some flexibilities also there. So we can compare our traditional assets with debt and hybrid funds. Like if you look at the left side, the traditional asset like FDs or physical real estates are typically used for capital parking. Yeah, you put money away and lock in it and expect it to remain stable. It was mostly stability focused by design. Your goal is to avoid surprises, avoid volatility, and avoid frequent decisions to take. But this also means limited flexibility for you. Once money is parked, it's hard to adapt if like any change in interest rate or suddenly if you have a sudden shift in your goals any market in sudden market environment or evolves. So the traditional assets prioritize certainty today, even if it reduce options later. But on the other side, you have debt and hybrid funds work with a very different philosophy. Here, the approach is risk managed investing, not just capital market. Liquidity is intentionally kept tight. It is very you can easily get your money 1 or 2 days in this kind of product. Like here, money is not meant to be locked. It's meant to be available. If it is required, you can take uh, at some point. Most importantly, this is also very adaptable cycle. They have someone who can manage. They are adapting to the different interest rate cycle, different market environment, the sudden economic changes. So the portfolio is adjusted within the defined limit instead of just static. So once we understand this product, like once we accept that relying only on fixed deposit and real estate as limitation, the next question is what do conservative investors actually do instead? The answer is not aggressive equity exposure. It's choosing the right categories within the debt and hybrid product. First, we start with the debt funds. Okay, the first category is we can see the liquid fund. It is very much similar to our savings account or short-term FDs. It is actually mean for liquidity. If you want, if you have any excess money, you can park it there, or you have any short-term goals within the 6 months within this kind of duration, you can park easily here. It's not for chasing returns. It's if you have excess money, you can park it here. Maybe another option we can consider is corporate bond funds. Here, the focus is mainly on strong quality companies. Also, it's a similar predictable income. These funds aim to deliver stability with slightly better efficient than traditional deposit. And if you look at funds, they mostly invest only in government securities, so the credit risk is very low. But however, the prices can move when the interest rate changes. So there will be some volatility, but this can be useful when the cycles will turn favorable. The most common theme across all this designed to manage risk within fixed income, not eliminate it completely, but control it thoughtfully. If you look at hybrid fund, it's often misunderstood. People assume like there are equity heavy aggressive, but if you look at there are certain categories which is mostly on the conservative side, which is risk is very much controlled. If you look at the conservative hybrid fund, mostly structure into the mostly 70 to 80% they are investing in red product. Only some 20 to 30% they will take risk in the growth. So the equity portion is for a just growth portion. It does not give you the excitement to give them some excess growth. If markets do well, maybe equity adds some incremental returns for you. If markets are big, still your portfolio is still anchored by debt. So this category is suitable for investors who are comfortable with small fluctuations but don't want their entire portfolio exposed to equity risk. And another category you can see is equity savings fund. This is slightly different product. It's like a portion of investment in equity, some of them in debt, and also some of them are hedged in derivatives. Or so they are doing the arbitrage kind of strategy. So it is mainly for the tax efficient purpose. They are the risk control. Even though equity exposure is hedged, which limits your downside volatility. The debt portions provide stability for you. So the experience for the investors usually lower volatility than the pure equity, and also it's give you the better tax efficiency than pure debt, and also gives you smooth returns over time. These funds are designed generally for investors who want controlled equity exposure, but without the emotional ups and downs of the stock market. And another categories we can see the balanced advantage, or the DAF, we can call dynamic asset allocation funds. This actually works very different. Here the fund does not have fixed equity allocation permanently. Instead, exposure is adjusted dynamically based on the market conditions. When markets are expensive, equity exposure is reduced. The debt exposure will be increased. When markets are reasonable and looks attractive, they increase your equity exposure. There, the idea is simple. They take less risk when markets are costly. Take more exposure when valuation looks comfortable. For conservative investor, this structurally ill because designs are rule based, are not emotional. The allocations are adapt automatically. The portfolio doesn't remain static in different market cycle. They will adapt to the market situations and environment. If you look at this is look at the table, it's kind of you can see the difference between the FD and debt funds and hybrid funds. In short, if you look at your first, so the primary role is the difference between difference becomes very clear. Fixed incomes are mainly used for your capital production. That's the core purpose. But if you look at debt funds, it had incomes with flexibility, especially around liquidity and taxation. And if you look at hybrid funds, it aims to balance the stability, and also it gives you some exposure to growth, particularly for some long-term goals. Once you understand this role, everything in looks simpler. If you look, next thing is returns and inflation. FD returns are fixed and predictable, which looks always very comfortable, but post-tax often struggle to keep it pace with inflation. But if you look at debt funds, it's are very pretty much market linked, but relatively stable. Over time, they tend to align better with inflation than FDs. But if you look at hybrid funds, they add a small growth engine through equity exposure. That's why they offer better long-term inflation protection, even though returns are not fixed. And if we come to volatility, FD have no volatility. You know your returns and duration and everything. But if you look at that one, they may be volatile. Maybe then NAV may be changed based on some market movements, but it is also not like too much fluctuation like equity products. Maybe some fluctuations will be there. But if you look at your long time, but maybe your goal frame time, it will come to the normal situation. But if you look at hybrid funds, it is slightly moderate because some equity exposure there. But if you have a specific goal time like 2 years, 3 years, and you park rightly, once the time comes, you can get your desired returns at the time. But if you the important thing is liquidity. In FD, slightly moderate. Once you logged in, you may have some penalty applies. If you want to redeem it before your tenure ends, maybe some penalty applies. But if in debt funds, you can easily get in. You can redeem if you want some emergency. You can redeem immediately, maybe just transaction plus 1 day. In hybrid fund also the same thing. You can get your money in mostly in 1 or 2 days. When come to the tax efficiency, your interest are taxed annually. So maybe that may affect your compounding and all. But if you look at debt funds, it's mostly your gains are taxed on the redemption. But, and at the same time, hybrid funds are more tax efficient. Most of them are some of the product like equity savings funds are only on the capital gains. But if some of the debt products maybe if you hold for 2+ years, you may get you get the capital gains tax also tax only. And if you look at the flexibility, FDs are very less flexible. You may have to put your money there and you have to wait once the tenure is over. But if you look at debt fund, it's mostly you have the very good flexibility. If you want, you can redeem in both debt and hybrid funds. If you look at what each product is best suitable for, if you look at FD, it is mainly you can good for your short-term safety, and if you want to park your money. But if you look at debt funds, it's mostly for your conservative income needs or for your short-term goals, or like that debt funds also good for hybrid funds. Maybe if you want to be stay on conservative but still you want to invest for certain more long time, this option will be give you the enough flexibility. This think of this table as not as a choice as spectrum. If FD sits on one end, maximum certainty with minimum flexibility, and if you look at hybrid funds, they have the controlled growth with lot of adaptability. It's in a well-structured conservative portfolio. Usually use all three, but for your different purposes. See, if we look at key takeaway for the webinar is safety must be measured, not just assume. When feels what feels safe emotionally doesn't always translate into safe outcomes financially. Real safety comes from understanding how money behaves over time. Second is inflation. It is a silent risk. It doesn't create panic, but it doesn't show up on statement, but it quietly erodes purchasing power year after year. Ignoring it is, if you ignore the inflation, maybe it's one of the biggest mistake you can face. But next one is the liquidity and liquidity. It's more than we realize because we plan to use money suddenly or tomorrow we need it, but because your life rarely follows a fixed schedule, so the ability to adapt it's really matter. So if you need some urgent money in case if you stuck in real estate or FD, you cannot able to easily redeem or purchase it. So that modern approaches like debt and hybrid funds will give you the flexibility. If you want, you can redeem at the right time. And also the ability to adapt is really matter. Like the controlled market exposure can improve your outcome. This is not about taking aggressive bets or chasing returns. It's about following growth to play a supporting role. So long-term goals don't depend only on stability. And finally, if you look at traditional assets still have a role. This is about rejecting a fixed deposit or ERC. It's about using them thoughtfully alongside these instruments also that offers balance, flexibility, and growth. The goal is not to take more risk, it is to take better understood risk, aligned with your time, goals, and comfort. See, so it is like if you want to know more about or you want to invest in these products, you can. We have a finance and milestones to wealth. It's a program to guide investors to help investing. Uh, so finance is mainly for purely for the conservative investors who want to take that exposure in the safety plus limited growth approach we can take. So what we actually do in our MTW program, we enroll investors, we educate them regularly, we guide and teach this kind of through the learning program, and we coach them. So about the investment, and also we can measure our your goal and we can track your improvement and how your performance. This actually we are doing in our MTW program. See, the outcome is if you have the financial discipline. Once you know how to invest to in a different cycle, we teach you that's you can be financially disciplined, and also you will have the growth mindset. Like you will have the conviction, like we our with our investment philosophy we give the conviction to how to be investor, and we will give you the roadmap to how you can build your financial goals. We give you the will give you the long-term wealth map, and also it's scalable for you. It's easily measurable for you your outcomes. And the finance is like we have a month, every month we will share the outlook about what exactly happening in the fixed incomes and side. And also we have a monthly webinars. Every month we have one webinar related with fixed income, and we will guide you to how to select the product, which product you can select. And also we have a frequent investment reviews for you. And also we will provide will assist you how to construct a portfolio also for you. So this is a promise we can deliver.
Thank you for spending time with us on this Learning Saturday initiative. If you feel at any point that you want to take this conversation forward and you want to translate this learning session into an investment journey, please do reach out to us on WhatsApp. The number is on your screen. You can just send us a quick message and we'll be able to get in touch with you. We'd love to work with you on your 1 crore journey and beyond. Thank you for your time today.